Welcome to the Deep Dive. We're your regular stop for breaking down the latest earnings calls and getting straight to the insights that matter. Today, we're jumping into VSE Corporation's second quarter 2025 results. They just released their numbers, held the call, and we've listened in to pull out the key stuff for you.
Exactly. And our job really is to give you that concise, informed take, not just the numbers, but what they actually mean for VSEC's strategy, where they're headed, and especially considering how the market reacted almost immediately.
Right. Let's kick off with those headline numbers, the ones that really sent that clear signal. VSEC had a notably strong quarter. Adjusted EPS, that's earnings per share, hit $0.97. That smashed estimates, which were sitting around, $7.75?
Yeah, significant beat. And it wasn't just EPS. Revenue also blew past expectations. Came in at $272.1 million. The street was looking for maybe $263.4 million. So that's a really robust 41.1% jump year over year. Shows real top-line momentum.
And digging into profitability a bit. Adjusted EBITDA was $43.5 million. That's up 51.9% year over year. Strong growth there. The overall adjusted EBITDA margin was about 16%. But the aviation segment specifically, that margin improved to 17.1%. That's nearly a full point, about 80 basis points better than last year.
And what's really striking, it isn't just the beats themselves, it's the narrative management pushed. They kept saying record revenue and profitability. It really shows, undeniable operational momentum right now.
Definitely.
Plus, they generated positive free cash flow, about $6 million, which is pretty significant when you're in the middle of this kind of transformation. And they kept adjusted net leverage pretty healthy, around 2.2 times.
That free cash flow piece, $6 million, while doing all this M&A and the divestiture, that does stand out. Is that a sign of real underlying strength?
Oh, absolutely. Generating positive cash while you're selling off one big piece and buying up several others, that speaks volumes. It says the core operations are running efficiently, they're funding their own growth, essentially. It's exactly what you'd hope to see.
Okay, good point. So let's unpack this a bit more, because these strong numbers, they're really the result of a deliberate strategy, aren't they? VSEC's been on this multi-year path to become a pure-play aviation aftermarket company. This quarter feels like a major milestone in that.
Exactly right. The really big final step was selling off the fleet segment. That went to One Equity Partners, closed April 1st, brought in potentially up to $230 million. And strategically, that lets VSEC just laser focus on the higher growth, higher margin stuff. Distribution and MRO.
MRO meaning maintenance, repair, and overhaul, for anyone less familiar, keeping planes flying.
Right, within the aviation aftermarket specifically.
And they weren't just selling, they've been buying too, what they call accretive M&A acquisitions that boost earnings. Like on May 1st, they picked up Turbine Weld Industries, cost about $50 million cash, and that move immediately expanded their engine service capabilities, added some proprietary repairs, and deepened those crucial OEM relationships.
Yeah, and don't forget TCI. That acquisition closed back in April 2024 for around $120 million. Management pointed out it's now one of their fastest growing units. Seems to be fueled by strong OEM engine partner backlogs and, winning new business.
Okay.
And then there's Kellstrom, acquired last December, that's also performing well, integrating smoothly, and really focusing on those higher value, higher margin engine parts, like for the LEAP engine platform.
That is a lot of M&A activity. Integration is always tricky. Did they talk about how they're managing that, avoiding disruption?
They did. And what's fascinating is how these aren't just random buys. They're designed to build scale and operational leverage. Specifically with that OEM-aligned distribution and MRO focus, it's all under one aviation segment now.
Makes sense.
And importantly, they stress that integration, particularly for TCI and Kellstrom, is actually ahead of schedule.
Yeah.
The biggest challenge, they said, is always managing the customer and employee transition smoothly while capturing those cost synergies they plan for.
Right. You can't just bolt companies together.
Exactly.
And you can see that strategic focus in how they've changed their approach to USM-used serviceable material. Management was pretty explicit about a pivot there. It used to be more opportunistic, like finding deals on parts.
Right. Almost like speculative trading.
Is
But now they've repositioned USM as a strategic enabler.
Yeah.
Basically, it's there to support their new part distribution and repair services. They're moving away from just trading standalone parts.
Interesting.
Now, this did mean about a 20% drop in the USM revenue run rate in the first half of the year. And this is, key management says it's driving significantly stronger margins.
So less volume, but better quality business, almost like shifting from a parts trader to a more strategic partner in the supply chain.
Precisely. It aligns them much better with the OEMs and the long-term trend towards, quality control and integration. It actually de-risks the business model.
That's a smart move. And they also flagged some new partnerships. The big one seems to be a 5-year deal with Eaton for hydraulic pump MRO. And apparently this is Eaton's first aftermarket repair partnership ever.
Yeah, that's a huge endorsement. Really speaks volumes about VSE's capabilities and trustworthiness as an OEM partner.
Definitely.
And that other program, the OEM licensed fuel control one, that's on track for full production early 2026. And they said the margin contribution is already baked into their current financials. So the benefits are already starting to flow through.
Okay, so great results, strategic moves paying off. But what about the market backdrop? Did things just fall into place, or did they execute well despite challenges?
Well, management did acknowledge the quarter started a bit soft.
Yeah.
There was some aftermarket uncertainty, maybe related to tariffs.
Right.
But they said activity rebounded quickly in May and June. Things picked back up.
Good to hear.
And looking forward, they see continued strength, specifically in the engine segment of the aviation aftermarket, which is crucial because engine-related MRO and distribution, that's now over half of VSE Aviation's revenue.
Wow, over 50%.
Yeah. It's a deliberate focus. It's one of the fastest growing areas and also one of the most supply-constrained parts of the market right now. So they're positioning themselves right where the demand is hottest.
And clearly, the integration work is helping them capitalize on that. You mentioned TCI and Kellstrom are ahead of schedule.
And they've already captured a good chunk of the expected $4 million in cost savings from Kellstrom just in the first half of the year. Turbine Weld integration is also moving along well.
So strong execution on that front.
Which brings us back to the balance sheet.
Right.
That flexibility is key for what comes next. That 2.2x adjusted net leverage gives them room to maneuver for more strategic growth.
And they expect it to go down.
Yeah, management actually guided that they anticipate leverage will be south of 2 times by the end of this year. That signals a real balance sheet strength and capacity for future deals or investments. They essentially got a financing upgrade with that new credit facility too. More flexible, lower cost.
Makes sense. And that Eaton Hydraulics deal, they see real potential there.
They do. They estimate the market size somewhere between $50 and $100 million. And VSEC thinks they can win share by offering faster turnaround times and that OEM authorized quality stamp. It's a new growth avenue for them.
Interesting.
And this all ties into how management sees the industry cycle playing out. Their view is that the engine aftermarket is going to keep growing faster than the general component side for at least the next 3 years.
Why is that?
Mostly ongoing supply chain issues and just not enough MRO capacity out there for engines. So VSEC focusing heavily on engine services looks pretty timely, potentially setting them up for, multiple expansion and getting a higher valuation for the market.
Okay, let's bring in the investor angle. How did the market actually react to all this on earnings day?
Oh, it was unequivocally positive. The stock jumped, 9.5% in pre-market?
Yeah, something like that. And it closed the day up over 10%. Trading volume was way up too.
Clearly, investors like this story. Strong alignment between the message and the market reaction.
And if you zoom out, VSEC's performance has been pretty stellar recently, right?
Absolutely remarkable. Over the last year, as of early September, the stock's up somewhere between 90% and 98%. Even over the last 3 months, it's up around 22.5%. Solid returns.
How does that compare to the rest of the aerospace sector?
It blows it away, frankly. The main sector ETF, ITA, was up maybe 44% over the past year.
Wow.
So VSEC is significantly outperforming. It really highlights how well that pure play aviation pivot and the acquisitions are working in this strong aftermarket environment.
So looking ahead, what are the key things investors should be watching? What are the potential catalysts?
Okay, several things. First, can they keep hitting that raised margin guidance, that 16.5% to 17% range? Margin cadence is key. Second, are they generating real cross-selling wins from integrating TCI and Turbine Weld?
Right, making 1 + 1 = 3.
Exactly. Third, look for more distribution awards, maybe expanding those OEM partnerships like the Eaton one. Also, any further balance sheet moves after they get the final payout from the fleet sale earnout could be interesting. And finally, the nitty-gritty execution stuff. Hitting repair turn times, managing inventory well, getting those OEM authorizations. Those will be the gating factors for whether the stock gets that higher valuation multiple heading into 2026.
So wrapping up the core message for our listeners, what's the big takeaway?
It's really a story of successful transformation. VSEC executed their strategic shift brilliantly. The acquisitions are working. Operations are strong.
Yeah, and they backed it up. reaffirmed that strong revenue growth outlook, 35-40% for the aviation segment this year. And importantly, they raised the bottom end of their adjusted EBITDA margin guidance, now targeting 16.5% to 17%. They're clearly confident.
Definitely putting their money where their mouth is. And the market heard it loud and clear.
All right, now for the fun part, our This Is Not Financial Advice segment. Got an outrageous but plausible trade idea based on all this.
Okay, let's preface this heavily. Not financial advice, just a thought exercise based on the discussion.
Understood. Lay it on us.
So the core thesis is this. The market is really starting to get the VSEC transformation story. They see the strategic positioning in that hot engine aftermarket. You've got leverage dropping below 2x soon, a good M&A pipeline, organic growth from partnerships like Eaton, and that USM shift boosting margins and quality.
Okay, makes sense. So what's the trade?
The idea would be to go long VSEC stock,
Yeah.
VSEC, but maybe juice the potential upside with a long-dated, out-of-the-money call option. Think 12, maybe 18 months out. It gives you leverage exposure if the stock really takes off, betting on that continued execution.
Right, the call option gives you the right, but not the obligation to buy later at a set price. So where's the outrageous part? What's the bold bet here?
The outrageous element is betting that VSEC doesn't just meet their raised guidance, but significantly beats it. Maybe because synergy capture accelerates even faster, or the engine market stays even hotter than expected. It's also a bet that the market starts valuing VSEC like other really specialized, high-margin aerospace aftermarket pure plays, not its old peer group. So you're effectively anticipating maybe another 20-30% upside from where it is now over that next 12-18-month time frame as the market fully buys into the transformation.
Got it. A bet on continued, potentially accelerating outperformance and a re-rating by the market. Plausible, definitely requires conviction, though.
Exactly. High conviction play.
Well, what a quarter for VSEC. To sum it up, fantastic results, driven by that successful pivot to pure-play aviation, strong execution, integrating acquisitions well, robust financials, confident outlook, raised guidance the market clearly approved.
And just to reiterate, this was our deep dive into the earnings call, definitely not investment advice, but hopefully it gives you a good picture of a company executing a major strategic shift in a really interesting market.
Indeed. And it leaves us with a thought. Given how well they've integrated deals so far, how much more of this fragmented engine aftermarket could VSEC consolidate? Something to ponder. Thanks for tuning into the deep dive.